right, guys. I think we've had enough, audience right now to get started. Hi, I'm Nagashri. I'm a board member at Women in Cleantech and Sustainability. I am also the chair of the Entrepreneurship Committee, and I'm really excited to have you all join the Founder Series. Evine, if we can move to the next slide. So this is for some of you guys who don't know about Women in Clean Tech and the Entrepreneurship Committee. The Women in Clean Tech is a nonprofit organization that is helping support women within the clean tech and sustainability industry. We're based on four main pillars of bringing about parity for women in these industries, as well as create events that help, bring us together and raise thought leadership. We also are there to form connections and local chapters. We have our headquarters are here in San Francisco, and we have chapters in New York, as well as a European chapter. And we're working on building a chapter in Seattle, San Diego, Denver, and New England. The Entrepreneurship Committee is similar to Women in Clean Tech, that we work towards bring about parity of women founders in this, in this industry. And I'm really excited about this program that we bring to you all. We also have our annual pitch competition that is up and coming on April 20th. And so please come and attend and support fellow entrepreneurs in that. And I'll share the event details at the end. With that, if we can move to the next slide, Evine. The main goal of the Founder Climate series is to create a robust set of tools to give to you guys, is hands-on workshop like today. And then we have fireside chat that we had last week. We talk with VCs as well as founders and understand what does that journey look like. We also host networking circles where you guys can hop in and talk to each other about how you did something, as well as what are some of your challenges. The next slide. We've, conducted this is our fifth, week where we're bringing you all of these programs, and we have many more events coming up the following. So please look out for additional workshops, fireside chats, and networking event to come up. And next slide. I want to thank all our speakers who take the time to support us, and to you all. And you've met some of these folks, and you're going to meet Yvonne today, who's going to do a workshop on financial attractions. And with that, I'd love to give a quick peek into my introduction. Evine, next slide. Yeah, so about myself, I'm Nagashri. I have 15 plus years of experience in clean tech and sustainability. I have a bachelor's and master's in architecture. I've, worked in the building industry with all things energy efficient and behind the meter, building large scale projects. I pivoted to renewable energy and storage and was with Tesla for about 6 years, scaling business and operations for Powerwall and Solar Roof. I took a 2-year stint to start my own company that's helping connect climate young professionals to climate jobs. And my company's name is Gaia Force. And meanwhile, I also joined Women in Clean Tech as a board member and as the chair of Entrepreneurship Committee. With that, I would love to hand over to Yvonne. And Evine, if you can stop sharing the slide. And Yvonne, over to you for your own introduction and for the workshop series. And folks, please feel free to turn on your cameras and drop in your LinkedIn for connections in the chat. Thank you.
Thank you, Nagashri. And my name is Ivan Markman. Hello to everyone. Very happy to be here and comparing notes with you all on how to best leverage showing the proof around milestones and financials to help you win the capital support and more broadly, kind of build your businesses. So I'll share a little bit of background on myself, then I'll cover some content. If you have questions as I'm running through a content, you can put those in chat. We will take stock of those and then we will answer them at the end. I just want to make sure that we get to the end because there's some nuggets in there that wrap the whole thing up. So maybe some of your early questions are answered later on, and if they are not, we'll make sure to answer them towards the end. So a little bit about me. You'll notice that my accent, there's something in my accent. I'm originally from Argentina. And as a good Argentinian, I keep scores in soccer style of certain things. So I've been an entrepreneur 4 times, and it's a tie. Two were good, there were exits, and two were failures, and those are listed there. The most important one was market share, which was a $500 million exit. We raised 90 million. We made a bunch of acquisitions. So I'm hopefully bringing some of that background to the conversation today. I've also been an exec, and I consider that a four nil in terms of experiences that I've treasured. They are, with a company that sold to Yahoo, with another company that sold to a private equity firm. I helped turn Comscore around. And then lastly, I joined Verizon to help turn Yahoo around, and we ended up exiting that to Apollo, the private equity firm. So that's the stats at the bottom. So 9 billion across three exits, ton of M&A, turnaround, and also 1,000 mistakes throughout that I'm hoping I can also share. And on my own, so that's self. I've touched over 40 startups as an advisor, an investor, in some cases, a board member. And these are the sectors that I've covered. And throughout those, helped raise about 300 million. We had a series of exits. There were two founders fired in that experience, and infinite learnings. So again, I'm hoping to share some of that with you. So today, I thought that I would break the content into four core areas. First and foremost, what investors actually care about and why. Second, how do we show the proof? And I realized that within Cleantech, there's a host of different business types and business cycles. So trying to address those and map those to the life stage. Then talk a little bit about some common mistakes that founders make. And again, as I shared, I work with a series of startups. I get pitched all the time. I'm part of a nonprofit in Southern California that helps founders hone their pitch and ultimately fundraise. It's a free service, and we see a lot of pitches. So there's a series of common mistakes that I can highlight there, and then maybe some creative ways to show proof. And I'd love to leave you with some kind of practical takeaways coming out of it as well. So I think one of the first important aspects to keep in mind is investors don't fund potential. They fund evidence. They are looking for evidence of that potential. And really, as a result of that, the big gap between a compelling pitch and a fundable company is that one thing. It's proof. So let's jump into it. So first and foremost, what do investors really care about? And at the highest level, the answer is very simple. Can I make a return? And how confident am I that I'm going to get that return? And so think of it as return and risk, and every investor is trying to minimize the risk and maximize the return. And typically, there's going to be three areas that they are focusing on. The first one is, to what extent am I seeing signals of demand? Is the market really kind of pulling this, or is the founder pushing this and it's a solution trying to find a problem? The second one is, so in that first bucket, obviously, to what extent do I believe that there's enough of a market and that that market is real? The second one is, you know, can this team deliver? What are the signals of execution? To what extent do I believe that the team here can deliver and get that opportunity? And then the third one is the durability. Is this a real business? To what extent can this business endure some of the economic, competitive cycles and other risks going forward? So then this turns into proof that we as founders need to be providing. And, proof means different things at different stages. So I'm going to try to cover those. At the pre-seed stage, it's all about founder conviction and some early signal. So here we're looking at customer discovery, letters of intent, some sort of working prototype, and really trying to understand founder market fit. And again, we're going to get into this in terms of how do you prove this. At the seed stage, we have already de-risked some of the core assumptions. So we're trying to understand and we're trying to see, either pilots with measurable outcomes, some early contracted revenue or contract paths, some form of replicable unit cost, and then importantly, key hires that signal that we're serious in the market and that this is a real opportunity. Talent is kind of flocking to it. And then at Series A, there's a lot more about replicability, right? And to what extent are the unit economics real? To what extent are they repeatable, and whatnot? So how do we show the proof? And I'm going to address these across each of these business stages. And what I'm going to try to do is to also share some examples by business type and some resources. So once again, at angel or pre-seed stage, for the most part, investors are buying you and your conviction, right? And every proof point that we provide needs to be taking some uncertainty off of it. So as I think about the staircase, the building blocks for proof, the first one is customer discovery. How many interviews have we conducted? What are the specific quotes, right? Being as specific as possible, as opposed to saying, hey, we've done extensive research, or here's like some market research out there, being super, super specific. And naturally, the more customers that you can cover, the better to validate your thesis. The second one is some sort of signal of demand that goes beyond customer discovery. We have a letter of intent for a given customer that if we do A, B, and C, we can get going, or we have already framed some sort of pilot commitment. And really, once again, being very specific. I typically have these conversations with founders where they're like, hey, we're running a POC, we're running a proof of concept with this particular customer. I'm like, great. What C are you trying to P? Right? What concept are you trying to prove? How are you measuring it? And once you do, what happens on the other side? To what extent have you already contracted or pre-contracted or agreed to the terms that relate to what happens on the other side? And you'll be surprised, most of the times the answers are not great. And it shows that, the founders naturally are trying to get in the door and start showing that something works really quickly, but miss a series of steps that look ahead and say, hey, real signal of demand is when someone starts running a POC, but where they already have a business case or a sense for what they will do on the other side, and we know how to monetize it. The third one, and depending on the business case, there's a lot more. there's a lot more requirements, if you will, which is more around the technical proof of concept. Obviously, a working demo is better than a deck slide, and showing some of the core elements that de-risk the science the most is super valuable. Granted, you may not be able to fully do it at this point in time, and we'll talk about that because for certain businesses that requires a bunch of investment. And look, investors understand that if you're talking to a right investor, so they may be focusing on some of the other aspects and helping you fund that technical proof of concept. And then the last one is founder market fit. And this is super, super important. Like, why are you the right one? Why are you and your co-founders the right people? What is true about you, and how can you show this to us? Make it as concrete as possible. So, okay, just to recap, at Angel and Precede, once again, it's all about proof around you and your conviction around the opportunity. Now, when we move to seed, um, investors already want to see that you have de-risked the most important assumption or assumptions around the business. Not everything needs to be working, right? But some of the critical aspects do need to be working. So let's say that at pre-seed, you had identified a big opportunity in a new technology that allows us to recycle garments and potentially upcycle or kind of re-commercialize them. Um, in the pre-seed stage, you might come in and say, "Hey, I was in this space. I could see just how much waste was there, the carbon impact of that space, all of the toxic waste that was as a result of that, and you can actually quantify it. You can walk people through what life looked like for you or for your customers and what you were observing. I've talked to tens of my peers, and this is what they say. And with this solution, I already have 5 who have signed letters of intent that they are going to run through it. And we want to run through it because we want to prove that the economics of the process, that the unique economics of the process work. When you get to seed, if that is the biggest risk factor, you will have made significant traction, if not already kind of fully proven that. And at that point in time, you're moving into the next areas that may have to do with, okay, who are your target customers? How are you selling to them? And how do you scale it? So, as I described, one of the main areas of proof that we're looking for is pilots with measurable outcomes. The second one is some level of early or contracted revenue, right? So maybe you got one of the pilots to pay you something, and you had set the terms that if you deliver certain metrics, you are going to charge them on an ongoing basis, and there's a contract on the other end. This is very important. And sometimes, for first of a kind, or for projects that require a longer duration, maybe it's one component of everything that we're trying to build, but it's one of the components that is central to the whole thesis. So once again, can we describe that and walk through it and really show some of the key elements of the economic model? And then lastly, typically when you're raising for angel and pre-seed, you have some hires that you have in mind, and you're using some of the resources for those hires. So on that front, showing that you have been able to attract that talent, that is super, super important at seed stage. Okay, and lastly, and my assumption is that this audience is typically on the earlier stages. Definitely happy to talk about later stages, but here I'm covering seed through A. Series A investors are really buying a model to scale it, right? So they want to see proof that the unique economics are real, that the sales motion can repeat, and that the team can grow and scale it without breaking. So here, very important to show that slope, right? That curve month over month, quarter over quarter. We're doing the things, and this is what it's doing to revenue. And here's why when you put more fuel into the fire, you get more out of it. The second aspect is key unit economics. For when you're thinking about business models that are more subscription or um, software type, the customer acquisition cost, the lifetime value, the payback period, the some of those key metrics when we're dealing with hardware, certain things like the LCOE, some of the unit cost, and how that cost scales or is beginning to scale that slope. Then, retention, to what extent are customers liking and seeing value in what we're doing and coming back, reordering hardware. And look, in a way, churn is also a story. There may be certain things that we're learning about it and improving, and part of the race is to scale that. In many cases, we've had so much demand that we're not servicing those accounts enough, and we know that we need to make an investment, and that will pay back on the other side. Repeatable sales or deployment motion, operations motions, some of the core motions inside of the company, managing the supply chain that need to be important to scale. And then lastly, how well you're doing this in terms of cash and how much cash requires. And, the capital is going to be different for different companies, but to the extent that you need to unlock Series B and other milestones, how much will you actually need? And, certain capital going in produces certain amount of capital returns. And, as I highlighted, different businesses will need different proof points. Here I just listed some business models. Hopefully you feel represented in one of these or a number of these. There's a resource I really like. I included the link here in the slide, and we can provide it, I'm sure, with the recording, or I can paste it in chat later on. But Climate Brick is a group of investors out of Europe, largely out of Europe. There's a few US ones who created 7 archetypes of different business models and all of the milestones that happen over time together with financing and whatnot. So think of it as a navigational map for your own business model and the kind of proof that you need to have at each step along the line. Okay, so we talked about proof and the kinds of proof, and I realized that I've said a lot, and we'll come back to Q&A. But one of the things that is interesting and that I see a lot as I'm being pitched or participating in pitch is that as much as there's those opportunities to provide proof, there's a series of common mistakes that I see that founders make, and those mistakes, quite frankly, undermine that credibility. Let's go back to where we started. As an investor, I want proof. I don't want potential or a promise. I want as much proof as possible. I want to see those signals of demand. I want to see those signals of execution. I want to see those signals of durability, and we want to see those to be stage appropriate for the capital that you're raising. So these are some of the most common mistakes. I'll list out 6. The first one is just vanity metrics that are dressed up as traction, right? Pipeline is not revenue. MOUs are not contracts. Impressions are not customers. And, investors have seen all of this before. So, a very simple example of a fix, right? So we have significant pipeline. The pipeline is growing. We have great momentum in the pipeline. Okay, what does that mean, right? Show me proof. Give me like concrete examples. And once again, we'll come back to, hey, what happens when you don't have some of these? to what extent are there creative ways to show that proof? The second one is this pre-revenue by design trap, right? And I think that sometimes, and look, sometimes there may be a need for, typically early on, the startup is investing in putting things into the hands of the potential customers, right? So maybe, a pilot that we would charge for, we decide that we're going to do it for free. But once again, back to where we started, it all needs to be with a very calculated, intentional approach that gives the investor confidence and proof that you know that you're executing, that you know exactly how to turn that investment into revenue. Otherwise, you're just going to keep burning through pilot after pilot. So the other aspect is, once again, you may be investing in this pilot because you're trying to show certain technical readiness, right? And while you're showing technical readiness, it may help you validate the pricing or the value equation for your customer. That is not necessarily commercial readiness. Commercial readiness is a lot more about, I make 5 outreach, efforts to different customers to get back to me. One of those converts, and this is the motion that I'm running together with how I'm packaging my product to go sell them. So I think it's important to show those two side by side, and investors get it. Sometimes founders conflate the two. Oh, we have a pilot going on, and it's going great, and we have great momentum. And then okay, but once again, what C are you trying to P? What concept are you trying to prove? How are you doing that? And then how are you turning this into revenue? And then the third one, and sometimes I see this, is this whole notion of showing the ceiling and not the slope. We have a 50K pilot. Okay, great. But the most important thing is your momentum, right? Particularly at early stage. Um, and at early stage, that trajectory and the amount of demand signals that you're having, where I can say, okay, you have a 50K pilot. I can see that 50K pilot turning into hundreds of millions of revenue a few years down the line. That trajectory is definitely more important, um, uh, particularly early stage. The next one is missing the unit economic conversation, particularly when you're dealing with uh, hardware or products that require a more complex supply chain, production, etc. But even when you're dealing with software and you need to service your customers, what is that going to cost you? And sometimes you might not have it because you're early on, but at a minimum, you need to have a theory, right? This is what we're going to do. This is what it's going to cost us. And this is how it's going to scale, because then you can map to what you're doing now and how long it's going to take you to verify or validate those theses. That shadow P&L, which I mentioned here, even if you are early in the stage, is very strong proof of the middle lens, which is proof of execution. These founders know what they are doing. They know what they are looking for. They know how to look for it, and they know how to correct it if things don't come in the way that they are expecting. Sometimes, and this has fluctuated over time, but sometimes, there's a lot of setup around climate impact, and that is important. But the reality is that when we're selling into any type of customer, whether you're a consumer or you're a business, even if you're a regulated business that has made certain net zero commitments, at the end of the day, they are going to look at the cost of doing that and the value of doing that. Um, and I've seen a number of decks that have over-indexed on the climate impact and under-indexed on business proof. And at the end of the day, businesses are businesses, and there needs to be a compelling case for them to buy from you versus from somebody else. And again, I don't want to discount the climate impact. It is important, and in some cases where there's commitments and it's regulated, um, it's a requirement. But sometimes one of the mistakes I see is that the business side is under indexed. And then, the last one, and I spoke about it a little bit in terms of showing commercial traction and technical traction. Think about the audience and think about the meeting, right? So there's a first meeting. If they like you and the business, they'll ask for a second meeting, they'll start going deeper, et cetera, et cetera. And in that first meeting, you can have more of a business-minded kind of investors, or you can have some more technical investors. Sometimes I've seen people not well prepared, not doing their homework on who's going to be on the other side, what is their background, what have they invested in, et cetera, and showing up with the wrong information for the wrong audience. Okay, so those are some mistakes. We talked about proof, but then, in a bunch of cases, like, okay, how I might not have some of these. How do I prove it? How do I prove the business? So these are four approaches, and these are just, some examples for you to think about. One is, as I described, create a shadow P&L. You might not have been able to prove yet all of the elements around your deployments, but if you show that you understand the math, if you show the ranges that you're expecting, if you show what you will do when you learn and you are clear on when and how you learn it, that goes a long, long way into proof of execution. One thing, I'm on the board of a company focused on climate risk, and one of the things that they did really, really well for their Series A is, as part of their data room, they had a series of videos that they had recorded from customers. And these were pretty extensive videos, right? So even before getting into reference calls, you already had the voice of the customer saying in their own words why they were buying from this company, how it was valuable to them, where they could see it going. So, reference customers, even if those are the ones who signed the letter of intent, right? Just saying, hey, here's why I'm excited. Here's why I'm so excited that I have signed the LOI and I'm going there. That could be proof of signals of demand even before you actually have that revenue and be super valuable. The other one is, and I would say it's a mix of how frequently I see this, but really kind of telling the story around milestones, right? And it shows on execution, it shows a little bit on demand proof and on durability in particular, that you think ahead, you understand the journey that you need to go through, that you can think about some of the turns that could go in the wrong way and how you anticipate and manage that. So, this last round brought us this particular milestone. This round is getting us here. It prepares us well for the next round, and here's what's happening. This is another way to not only prove whatever you can prove looking backwards, but then also prove execution and durability, and that you understand how to move the business forward. And then lastly, I'm sure that to the extent that this is applicable to your business, you've probably done it or are trying to do it, is different forms of third-party validation. So, different types of grants, having participated successfully in accelerators or, competitions, awards, etc. Because they show that other people that are evaluating the space believe in it, believe in you. Okay, so this is the way I think about the investor confidence stack. So, we started talking about, how proof wins, how proof makes you fundable, funded, etc. And the way I think about it is this formula here, right? So proof is evidence of demand, evidence of execution, and evidence of durability. And no single pillar alone is enough. You need all of those, right? Because you could have evidence of demand, and if I'm not convinced that you can execute on it, then I'm not going to invest. Or if I think that you can execute on it and that there's demand, but that your solution is not differentiated and that you don't have a good path to differentiate it, or build some sort of moat, then it's not durable. So then, it's still not there. So that first point is very important, which is no single pillar alone is enough. And for each of these stages, you're moving the pillars from one assumption to the next one, right? So we talked about how in pre-seed there's a lot more around the founder or founders and what they can do. In seed, there's a lot more around what some of the things that you have already proven and how you're going to be de-risking the other assumptions to get to more repeatability. And then in Series a lot more around repeatability. Um, and this is very, very important back to what investors are looking for, which is the highest return at the lowest risk or lowest uncertainty. The founders who are really good at this, they not only generate excitement about the opportunity, but they are very, very good at reducing uncertainty and reducing risk for investors. I see a lot of, again, founders who rightfully so are incredibly excited by the opportunity and showing all of this upside, but don't spend that much time highlighting how they are de-risking, achieving that outcome. So the last thing I'm going to cover is a tool, a little bit of a proof audit that you can take with you and apply to your business, which is really kind of going through these questions for yourself. The first one is, which pillar is the weakest? Is it demand, signals of demand? Is it something around our execution? Is it something around durability? So really kind of think about how much proof you have in each of these verticals and score yourself honestly against where you are in your current proof. Then related to that, what is your single most credible proof point right now? And to what extent can you actually state it very succinctly, right? Um, you know, I have 40 customers that I've talked to who want to do this. 5 of them want it so badly that they've asked to be the first ones to try it, right? Really, kind of concrete. And if it's not, then you may still have a gap. And then think about the proof point that you could generate in the next 90 days. And if you are ambitious, or if you feel that you have a bunch that you need to work on, maybe it's more than one proof point, right? But set that target and kind of work backwards. And this becomes a super, super important near-term milestone. Once again, maybe you're like, hey, I've talked to 3 customers. I really need more customer validation. So that's going to be, my biggest proof point, because, we're an amazing team. And based on what we're doing, we think that the durability aspect is also one that is strong. We have a patent, whatever that might be. So that's it. We talked about, proof and the proof that investors are looking for at each stage. We talked about some of the common mistakes, and we wrapped it up with the proof stack, or the evidence stack, and a bit of an audit that you can take away with you. So with that, we'd love to open it up to questions. I'm going to stop sharing, and I haven't been tracking the chat. So
Yeah,
um,
you're doing great on time. We don't have any specific questions in the chat, but I encourage folks to raise your hand, and then we'll take up questions one at a time, and you can unmute yourself and ask the question. So the floor is over to the audience. right now? While people think up questions, Yvonne, I have a question for you in terms of showing traction and showing up that hockey stick of revenue. I've heard of anecdotes where people want up to 10 billion of revenue. And in your experience, when you're starting out in the early stages and you don't know how things are going to shake out, what is your recommendation on evaluating that hockey stick and making realistic assumptions as we do that?
Um, so typically at the very, very early stage, to your point, there's a lot of unknowns. The first part is understanding the addressable market, right? And sizing it up in a certain way, right? And that is important to when you think about proof of execution, part of what the investors are evaluating, whether it's like, hey, how do I get to 10 billion or whatever that might be, is, how do I think about it? And what proof can I get that they get it and that they will execute it and that they will break through walls to be able to do that. So what I would say is first and foremost, at least for me as wearing the investor hat, I want to know that you have thought through the market and the structure of the market. And what is the total market, what is the one that is serviceable more closely, and what is the one that you're gunning to obtain with what you're doing. So you go from the biggest number to the smallest number, and typically, the smallest number is where you're going to be playing in the next couple few years. Um, so the way that I've seen and by the way, there's no right or wrong answer on 10 billion or 500 million or whatever that might be. It may be the wrong or right answer for a particular investor, an investor type. And I'll come back to that as well, which is the founder's investor scorecard. And that's kind of a bit of a pet peeve of mine when I work with founders. And I'll come back to that. But just to finish answering your question, I think that the most important aspect is first knowing your audience. So who are you going to be meeting? How do they typically approach business? Typically investors will have LinkedIn posts or they will have some manifesto on their own site or they'll have been at a conference. There's a lot of ways, and particularly now with LLMs, you can say, hey, I'm going to go and pitch to this person. What should I keep in mind? Blah, blah, blah. You can prompt an LLM to help you prepare your strategy to go present. So first, know your audience. Second, typically have a very rational, logical sizing of that market that you believe in, and then talk about how you will go and capture that market and how you see yourself scaling if things go in the way that you think that they will go. So that may end up being, 300 million in 5 years. It could be whatever, 10 billion in 10 years or whatever that might be. But I would not get stuck on, the investors want to see that this company becomes 10 billion in revenue or something like that. The other thing that I would say is, um, and this was not the topic for today, but as important as the proof, evidence stack is, and everything that we talked about from the investor lens, it is important for you as a founder to have your own investor scorecard. So, one of my first questions to founders is, "What's your investor scorecard?" And in some cases, they parrot back to me how they think that investors will evaluate their business. So if I'm the founder of Company X, my answer to that question is like, oh, they will look at CAC LTV and they will look at SAM or whatever that might be. I'm like, no, 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 that's not my question. My question is, what's your scorecard as a founder for the investors that you want to partner with, right? Because particularly at early stage, these investors could be with you for 15, 20 years, right? These are people that, will need to be with you through the good times, the bad times, be helpful to you, et cetera, et cetera. And typically that scorecard has a whole series of aspects. But when you, as a founder, hone in on that investor scorecard, the flip side also happens, which is you know your audience, right? Because you've almost determined who you're going to be talking to and typically how they think about the business. Just to put the bookends of this, you could be going after a small fund that is a first time fund because you know that fund manager will work their butts off to help you as a founder. Um, or on the other extreme, you could be going after a very, very large, very well known established brand, you know, for different reasons. And again, none of them is right or wrong. It's what's right for you as as a founder. But then, you know, depending on those bookends, you may be approaching them, pitching them, et cetera, very, very differently. The proof lenses, the evidence stack will be the same, but you know, some of the elements as you learn more about them, they may be more technical, they may be more, you know, commercial, et cetera, et cetera. It will help you pitch them.
Great. Thank you so much, Faran. Anyone have questions that you would like to unmute and ask your question? Yeah, Maria, why don't you go ahead and unmute and ask your question?
Hi, thank you so much for the time today. I have a question regarding an AI LLM model that's native for the fashion production process to decrease textile waste in fashion production. Um, there's a prototype that's created. We've been partnering with someone who comes from the fashion industry, someone who comes from the tech industry, and also an LLM engineer. And my question is, at what point should we start showing the prototype to investors? How workable does the prototype need to be before we should be showing it to investors?
So I'll give you the short answer is it depends on the investor, and I'm going to use very concrete examples. There's a buddy of mine who is the founding GP of a climate tech fund called Third Sphere. And if you look them up, they will say that they're looking for companies with ugly logos and buggy demos, right? So, you know, they go very early and they don't care. They actually almost like if your demo breaks or something like that. But it's like, hey, they're looking at, you know, how do you, you know, more of that proof of execution. To what extent do they get it? To what extent do they understand the roadmap and where they need to go? Some other investors may be looking for something a little bit more polished. It also depends on, you know, maybe at the risk of stating the obvious, you know, how early you're going, and like, are you going to angel pre-seed, or you know, you're going more to kind of seed investors? Um, but yeah, I mean, this is also part, as I was highlighting, you know, part of that research on you know who your audience is going to be, and really kind of the flip side for you. So you mentioned, you know, AI for the fashion industry. You know, what's your investor scorecard, and who appear to be like the right kind of investors in that space? Then doing some research on them, you know, that will get you even a more tailored answer. You know, for those investors and what's going to be important to them. You know, for some it may be like, hey, they really want to spend time with you and learn more about you and your co-founding team, or they want to spend more time with customers, you know, and you know they might get to the demo later in the process.
Thank you so much. I appreciate that it's not a one size fits all model, but I also appreciate how you explained it.
Thank you, Maria.
Thank you, Maria, and thank you, Ivan. Anyone else have any questions? Feel free to unmute and ask your question. If not, I always have a series of questions, Ivan. So my question to you is, can you give us an example from your about reducing the uncertainties and de-risking? Like, what is a good example of that, and how do you demonstrate it?
Yes. So I shared a bit of an example on, I often hear about proof of concept, and then when you start drilling into that proof of concept, things begin to break, right? And create uncertainty. So, if you're running a pilot, if you're running a proof of concept, be hyper clear on what concept you're going to try to prove, how you're going to prove it, how you have gained commitment from the customer or the prospect that you're running the POC with. And then if things go wrong, how much commitment or how are you managing expectations with the customer, and what are you going to do? Because sometimes it goes wrong the first time, but you've set the expectation that, hey, we're both building this together, you're a design partner, it may break, you're kind of, while you're gunning for 100% success, it may fail 3 times before it's successful. And if you set the expectations, then you have another chance, and people are working on it because they are so excited about it that if it works, it's going to be so transformative for them. And then the other aspect of it is, as much as you can, and sometimes this is hard, but as much as you can, try to do what's known as challenge contracting, which is, if we hit these metrics, we already have a master services agreement and all of the contractual stuff on the other side, and you're going to pay X for a certain volume or whatever that might be. So it's almost automatic. You hit the POC, you move into contract. I mean, if I could wave a magic wand on the most de-risked version of that, is one where you have mapped all of the decision makers in the organization, so you know that if someone leaves or is let go, you don't, the whole pilot doesn't fall, there's a series of elements. So I've just given you, I don't know, 7 or 8 different ways that you can de-risk it. And you can apply this to other things like, we have a supply chain. There may be some potential points of failure in that supply chain. So we build redundancy and we have multiple vendors for those, or things like that. There's lots of ways to de-risk the business and show proof that you have de-risked it.
Yeah, that was a great example and more detailed on how you can, and I completely agree on the contracting side. And I don't know how much, a contract is visible and what kind of visibility you can give on contracting to your investors, but I do think like having visibility on what you're executing at makes complete sense. Guys, time has flown by and we've really enjoyed the conversation with Yvonne. I would like to take a moment before I let you all go is to go over some of the offerings that we have at Women in Cleantech. So I would first encourage you guys, since Women in Cleantech is a nonprofit, please come and become a member. Your membership is very valuable to us. We have recently acquired the 501(c)(3), and when we show traction, just like on our nonprofit side, we get our grant and funding because of the membership and volunteers. So please come become a member, volunteer with us, and continue supporting by spreading the word as well as supporting us through other ways. And then I want to take this opportunity to thank Yvonne. I know you're extremely busy, but we really appreciate your support to Women in Cleantech and this audience. We really want to make this group successful, and your support on showing us some of these things is hugely helpful. So thank you everyone for joining, and I wish you a lovely rest of your week. Thanks for joining us.
Thank you.